Welcome to Trader Chats, everyone. I'm Imran Larka from Options Insight, and today my guest is Tian Yang, who runs an institutional macro research boutique called Variant Perception. Hey, Tian, welcome to the show.
Hey, Imran, how's it going?
Good. Nice to see you, man. So why don't you tell everyone a little bit about your kind of career background, how you started in the industry, and how you ended up at VP?
So I started my career interning for you, right? That's the bombshell to drop at the beginning. I think it was still Merrill Lynch at the time. It hadn't been taken over by Bank of America yet.
Yeah, I remember.
I remember you as a very passionate teacher even then. I definitely learned a lot from you, but I think that passion also wore out some of the other interns a little bit
Yeah.
on the trading floor. So that was how I got started, looking at equity derivatives. So over time, I think that was a really interesting time to be involved on the sell side in terms of market making. But I think over time, I think my natural instinct was more drawn to kind of a slower moving pace, getting time to think and do more kind of deeper kind of research. So, as a result of that, kind of spent 4 years at Merrill Lynch or Bank of America Merrill Lynch, and then came to VP to work for the founder at the time, which was Jonathan Tepper. And obviously over time, kind of, the VP's gone through a few iterations, and I took over just over 2 years ago. So, today's version is kind of still research, but obviously there's more of a kind of model data angle as well that obviously we'll get into, I'm sure.
Yeah, looking forward to it. And on that note, I think you're right. I think a few of the interns used to get a bit scared. I was quite intense back then at the time, but that's where you had to be, man. When you're trading liquid products, you got to be that way. So it's good, but it's good. Yeah, so it's good that you found your way onto something that more suited your personality on the research side. So why don't you tell us a bit more then about what you guys do at Variant Perception and kind of the kind of framework that you've built there and how you like to look at things?
So I think we're essentially trying to sit in the niche between kind of data science and market history. So if you think about it, a lot of times, if you're a purely discretionary trader, essentially what you have is kind of your accumulated experiences, your experience of previous cycles, but it's going to be subject to certain biases, right? It's almost inevitable in terms of, how the human brain works. But at the same time, if you go for a pure kind of machine learning approach, then the tendency is that these systems backtest really well in sample, but out of sample, they're unable to pick up on kind of shifts in correlation or big regime shifts. So, arguably that's why a lot of the pure machine learning funds maybe haven't done as well as anticipated once they launch. So in theory, if you can do a bit of both, it kind of makes up for the shortcomings of the other, and you end up with a slightly more holistic approach, right? So understanding of market history and cycles will help you in terms of specifying your models or putting certain restrictions on it, or understand kind of when the model's kind of getting a bit out of whack. But equally, I think, in terms of where the world is going, it's almost inevitable you need a kind of data science angle, I think, to keep up in terms of understanding the analytics and just dealing with the kind of the vast amount of data out there. So that's kind of, how we think of ourselves a little bit. We're first of all students of market history. We spend a lot of time just reading financial history books, right? Reading kind of write-ups on different industry cycles and those kind of things. But then hopefully that gives you a good foundation to then try and start building models and bringing some of the more leading edge techniques.
So a lot of your clients are like some of the top hedge funds and that use your models to kind of help give them that edge. Is that right?
So I guess the client ranges from people who just want to read the research and just get a bit of what we're thinking, through to obviously data APIs, inputting the kind of data into their processes. So there's probably a mix at the moment. But I think the idea is that we've spent a lot of time trying to organically kind of combine market history and data science. And so over time, I think people like that we have a little bit of a handle on both. And then seeing the kind of cross section can spit out some really interesting ideas, right? Even recently, obviously, you're on the work, you see a lot of stuff, right? Where you see, say, the Japanese insurance, right? That's like an equity play, but implicitly, it's also a play on the BOJ, right? Your models led you, a lot of the kind of single stock, longer term models led you to that investment theme, a year and a half ago, a year ago, right? And that's when you first get interested. But then understanding kind of that the BOJ is a very unique kind of human overlay, and that inflation LEIs are through the roof and it's coming, then that gives you more of a kind of conviction or catalyst, right, for that kind of trade. So that would be like an example.
Yeah, okay, so let's dig a little bit deeper then into the type of models you guys run, right? So I think you're quite unique in that you've got tactical trading models that kind of help people time the market in the short term. Then you also got much big picture, structural, demographic, cycle-based models. So do you want to tell us a bit about those, maybe starting with the tactical stuff?
Yeah, so I think how I think about it is that there's essentially like two things you're trying to do when you're investing or trading, right? Like the first one is trying to think about what will happen. And then you need to kind of play the game a little bit, understanding what's priced in, for you to make money, who's losing money on the other side. So that's kind of like two distinct things. The longer term capital cycle structural models, that's a lot more about trying to think about what will happen, right? There's a specific sequence in which the economy usually operates. Certain sectors will always be leading and certain sectors always lagging, right? So, like the classic example we always give is, before you build a house, you need to get a building permit in most places, right? So the building permit data almost has to turn before the construction activity data picks up. And so you have a lot of these kind of leading lagging relationships, just like in the long run, ultimately for capitalism to even operate, money has to go from the lowest marginal return to the highest marginal return, right? But these things tend to take time, but they tend to be either persistent tailwind or persistent headwind. So those are trying to understand a little bit more about the sequencing and what will happen. The tactical piece, in my mind, is much more about just trying to play the game, right? Because obviously there's lots of different sources of edge and alpha people trying to take out the market. So for us, it's just trying to model a little bit how different participants are behaving and understanding, how people are positioned, so that in theory you can have that kind of playing the game edge on top of the kind of what will happen, right? So you're essentially looking for you use your longer term models to understand what will happen, and then you let the tactical tell you when people are positioned against it, and hopefully that creates a bit more kind of asymmetry, so that you can either put investments or structure trades around it that in theory should have some edge that pays off.
And are you using the tactical models to get into the longer term views, or is it a case of you can go against those longer term views if the tactical models tell you to?
I think for us and most of our clients and how we invest, like I think our time horizon is probably a bit more elongated. So I don't think we're really doing a lot intraday or even daily. So for us, it's a lot more about tracking the longer term themes and helping to, one is obviously get in and out, but two, just helping a little bit with sizing or, position management, right? The tactical is kind of a way to prioritize a lot of these ongoing longer term themes. But when a particular one gets too crowded, then it might be a good time to take some off or add some on, overlay some options and stuff like that. So in terms of the use case for us, that's how we use it. But we do have some more active kind of trading clients who actually have built up a lot of experience over time. And I think for them sometimes it's nice to have it as a like a slight data model check, right? Like LPPL being a classic example. I think a lot of traders have really, really good feel for kind of when things are getting stretched, right? When there's a capitulation kind of move. And they like the fact that, you can kind of confirm a little bit here, and it helps them so that, when you get your, you get a doji or like a shooting star or whatever, and then, that's their normal entry. Having this on top, they're like, they have some conviction on top.
Let's explain for the people who haven't heard of your LPPL model before, what it means, what it stands for, and what it's trying to capture.
So LPPL stands for log periodic power law. We didn't invent this, right? It's been around for quite a long time. It's used in academia quite a lot, and it's being found in like lots of different kind of fields of study, biology, all sorts, right? Like we came across it because it was being used in kind of various social studies, and Didier Sonnet kind of helped to really popularize the idea. So the theory is, if you think about it, it's basically like a wave shape where for each kind of oscillation of the wave, it tends to speed up and the magnitude tends to kind of get bigger, right? So intuitively, if you think about like a market that's really starting to move, say it's going up, right? And people being caught short offside, they get increasingly more and more desperate to cover their shorts. So on each cycle, they cover quicker and at a higher price, and you end up with a kind of exhaustion kind of pattern, right? So there's a couple of ways to get the intuition for it. So I think the LPPL itself, the theory is very sound, but like putting it into practice is actually extremely difficult. So the kind of model itself has kind of also gone through its kind of its own kind of hype cycle, in the Gartner sense of, obviously we're in like a massive AI hype cycle right now, right? And we've gone through various iterations. So I think Didier Sonnet put out a book called Why Stock Markets Crash. I think in the early 2010s, that got a lot of publicity. I think that probably marked the peak hype in kind of LPPL. And then, lots of people tried it, but found it wasn't very easy to implement. And then so I think we're probably through that valley of disillusionment now. And, I think we're getting some good usage out of it. Essentially, it's a very unstable model when you first look at it. So the practical aspects are all about how to make it more stable and to train it to be, to essentially pick out the correct kind of crash patterns versus other ones, right? So that's a little bit what it's gone through. But if you think about it, at heart, it's an attempt to try and understand the end of a trend.
Yeah, I guess if you marry it with other things that people use, like you say, technical indicators, maybe DeMark signals, things like that are commonly used with quite a lot of success to pick turning points, and you're getting lots of multiple things telling you the same story, then your conviction probably goes up, I guess, right?
Yeah, I mean, DeMark is really interesting because I think DeMark 13 counts. So the proper four, right? The countdown, the setup and the countdown DeMark. Yeah, it's quite amazing how a lot of times the DeMark 13 count, if it lines up with the LPPL climax, those are really compelling entry points. I think we found DeMark, there tends to be a bit more 13 counts on DeMarks on the dailies versus the LPPL climaxes. But yeah, I think it's obviously trying to get at a similar idea.
Yeah, I mean, I've definitely been tracking your LPPL signals recently, and you've made some great calls recently, right? I mean, the hard part I find though is whilst you might pick a turn, it's the exit point, right? It's like, how long is that turn going to persist? Is it just a dead cat bounce that it manages to pick out, or is it a major turning point, right? And these are where the trading side and the risk management comes in, so that you don't get too badly hurt if it doesn't turn into a material move, right?
Yeah, definitely. Because if you look at like the stylized LPPL climax examples, whether it's a bubble or a bottom, actually it's say like it's roughly right. It might be half the time you get like the V shape and you get it instantly working, but actually half the time it's probably more like just a sideways, volatile sideways price action. So it's definitely important to bear in mind that kind of base case for trading it. And obviously for LPPL generically, there's obviously a base case expectation for the forward range, right? So to the extent, you get immediate reaction, like a X standard deviation, even like 2-3 standard deviation daily move quickly, then it's normally a sign something's a bit weird. It might be a V, but it could bounce back. So I think in my mind, knowing that base case does help that. Yeah, if it moves quickly, you generally do want to probably take a bit off, right? Or
take some chips off the table,
or do a cut, flip to like an option structure on if you have the delta on, right? Something like that.
All right, cool. And then you've got a crowding model that you've recently been putting out. I've seen it on social media quite a lot. Do you want to tell us a bit about
that? So I think we've worked on numerous iterations of crowding kind of over time. So for us, we kind of do a bit of everything, right? Essentially, like the way we operate is we just spend a lot of time thinking, reading about history, and then trying to build models. But obviously, once the model's built, we want it to last, right? But it's generally hard because alpha will decay over time. Any model, from the moment you implement it, slowly the alpha will start decaying. So a lot of times we're trying to just kind of think very first principles at understanding aspects of the market. And hopefully if you have the first principles correct, then your model efficacy can persist for longer. So the crowding, this latest version is like another iteration. But by our heart, the basic idea is that crowding is firmly in the playing the game bucket of analysis, right? So you need to understand how all different participants are positioned. The problem with almost all like widely available positioning data is usually quite delayed, right? Whether it's like COT futures have like a week delay, right? A lot of the flow data might be a month's delay, some might be even longer. All position data is surveys, right? So you don't actually see the real numbers. So I think a lot of times what we're trying to think about is what's actually the inferred kind of visible kind of market observations if something's crowded or not. So on crowding, we're not necessarily trying to overfit our measure to maximize the theoretical alpha. What we're actually doing is saying if a position is very crowded, it's actually in the tails, you should see it, right? So it's more about this. So it's more about if a name is crowded, if say it's an equity and the stock goes and the stock is uncrowded, but the market goes up, then it should go up more, right? If with the general index. But if it's uncrowded and the index goes down, it should go down less, right? So there should be a difference in terms of what we call it quadratic beta, right? So you have a normal beta, you have a quadratic beta. So you should have an upward bias on the tails, right? Similarly, in terms of upside downside volatility, if a name is very uncrowded, there should be more upside volatility than downside, right? On average as the expectation. Similarly, if a name is uncrowded, you get positive earnings surprise, it should obviously go up more than it would if it was a crowded name. So those are kind of the objective functions we're trying to optimize for rather than alpha necessarily. So I think that's what, so the latest version, I think we got access to a bit more models than the first time we started doing crowding. We have our own kind of speculative versus patient money proxies now, so we can understand a bit more what speculators are doing versus kind of more real money patient guys. So I think that's helping kind of this version. But yeah, essentially it's just trying to understand which are the areas of the market where the kind of tails are a bit more skewed. And I think intuitively that makes that to us is what kind of crowding actually means.
Interesting. Yeah, you get exaggerated moves on extreme outcomes basically, right? Because everyone has to get out at the same time because they've all got the wrong position, right? That's kind of essentially.
Yeah, because you have times where a crowded name makes money, right? Because if everyone's crowded into something, but the what will happen is correct, then you should get paid out, right? Like everyone can be short bonds in 2022, but if the Fed keeps hiking, everybody makes money. Right? So that's why we didn't necessarily want to just fit to the theoretical backtest performance, but it's about what the behavior is, right? It's more like if you get an adverse event against the crowding, you really need to see that kind of tail payoff. And also it needs to, it also shouldn't really have very high correlation to kind of the price, right? Or, standard technical indicators like RSI or any of these, right? Because obviously if you end up building a model where your correlation is like 90% plus to RSL price, then the marginal information isn't that high, right? You can see the prices down. So I think that was like another test case where there's a lot of stocks we've tracked just personally having lived through the kind of experience of owning it, where we're like, okay, intuitively, there should be periods when the crowding have nothing to do with the price, and there are periods obviously when it's correlated. So those are some of the kind of test cases.
It's interesting. I think it would be very informative for an option trader on a name as well, because if there is that crowding, then you can say that the tail might be a bit mispriced versus that level of crowding. So like the skew might be too cheap or too expensive based on that crowding. So you could fade that in option space, and then there might be some edge to extract from that, basically, right?
That's like a one exact use case, right? So we have option guys who that's precisely what they're using it for heading into earnings, right? So the process is obviously understanding what companies have earnings coming up, having a look at where crowding is extreme. Obviously, you may or may not have edge in predicting the direction of the earnings surprise, but obviously in theory, if it's not, especially like, depending on the kind of vol surface of the time, right? In principle, there should be, over time, this should extract that kind of tail risk, right? That's kind of how it's being used, actually.
Interesting. All right. And then what about so the capital cycle is one of your main ways you look at it on a longer term macro basis, right? Can you elaborate a bit on the capital cycle, like the type of stuff you look at to identify that?
So again, the capital cycle, we didn't invent it. Like it's probably most prominently associated with Marathon Asset Management. Ed Chancellor wrote a very popular book on marathon and capital cycles. So that's kind of where I think where it got popularized within the investing kind of world. At heart, the capital cycle is actually about competition. So if you have certain industries or regions that are really, loved, sexy, and tons of money is flowing into it, if too much money flows into a particular area, then on a structural kind of 3-year forward basis, it will obviously compete away profits, right, over time, and vice versa. So if an area is really hated, there's just no money going in, then by definition, almost the marginal ROIC is potentially quite high if it ever turns around, right? And so there's a potential for kind of excess profits for that industry over time. So it's really about the steady and slow flow of money from hot areas to hated areas over time as money seeks out the highest rate of return within essentially a market economy, right? So that's kind of at heart the idea. So for the most part, I still think it works. Obviously, now that we're living in a world where there's increasingly more regulations or government interventions, right? There's obviously some limits on kind of this, but broadly, I think it's still, for now, still working. So that's kind of the idea. So we're just tracking, for us, I think we have about 400 different global region industries that we are looking at this on. So, mostly it's about understanding CapEx, R&D spend relative to asset base. It's about understanding kind of the marginal ROIC for the industry as a whole, and understanding if the asset base is growing or being drawn down. So that's kind of the idea. We generally try and build it bottom up. So we build it for both private and public companies to the extent the data is available and aggregate up. So you have a kind of cleaner feel for the kind of for these kind of dynamics.
So what is the capital cycle saying is hot right now or not so hot?
So hot on cap cycle would be bad. So hated would be good. So hated are the ones we probably pay a lot of attention to. So Latin America has been persistently capital scarce for quite a while. So structurally we've always been looking at Latin America as an area, right? And again, this is another example of kind of man plus machine hopefully beats man or machine alone, right? If I talk to you about LATAM, if you think back maybe 20 years ago, there's probably a lot more LATAM funds, a lot of LATAM PMs, hedge funds. Like there's very few left, right? So in a way, this is a little bit like the commodity capital scarcity, commodity super cycle in 2019, 2018, 2020, right? When all the commodity funds were shutting down, there were commodity PMs, energy analysts getting fired. So like there's also kind of confirmation around it. So right now, I think LATAM's very interesting. Japan, obviously, Japan's it's kind of ongoing thing. So Japanese equities, it still remains very capital scarce area. Within sectors, energy still, because obviously there's ESG constraints or various things that prevent too much capital being deployed into the sector. In terms of capital abundant, obvious examples, things like media entertainment. So we're talking, streaming wars, those kind of things, right? Netflix, Disney, everyone's obviously burning money right now to compete. So that's been a pretty capital abundant sector for a while. What else? Yeah, I mean, that hopefully gives you a feel, right?
Yeah. No, that makes sense for sure.
I guess the interesting, I understand a little bit. I guess what you're trying to hint at is you ask, because obviously with AI, with like semis, the question is that, is it actually capital scarce or abundant, right? And so I think this is really interesting where semis are rarely actually capital abundant on our models, even throughout the past decades, even as so much money is poured into it. And the main reason is that even though tons of money has gone in, the marginal ROIC for the industry has been very good. So that's actually being a very key input to kind of tell you that there's a secular shift going on, right? Because if you just do like a very kind of surface level implementation of capital cycle, the danger is you'll miss secular winners and be stuck in value traps, right? So like, if like an industry is dying, like, newspapers back in the day, or like different things like that, actually, even though there's no investment, there's no traction between demand and supply until the supply is truly being like destroyed enough. And so that's why having a marginal ROIC component is really, really important on top of the kind of all the other kind of capital expenditure, R&D flow measures, because it tells you when you're getting traction.
I see. So it's like the marginal, so that's return on invested capital, right? So
Yeah.
the marginal return on invested capital is effectively confirming whether or not there is capital scarcity or abundance. Because if in AI, for example, everyone's throwing cash at AI, but they're managing to have an ROI that's okay, then you're not so concerned that it's in a bad spot, basically. Like, it's almost another form of crowding, right? I guess.
Well, yeah, but obviously, well, in my mind, I think it's more about the actual underlying business performance. So, I guess in my mind, I'm thinking less AI, but more like just semis as a whole, right? So obviously, you're including TSMC, you're including more of the,
Yeah.
these kind of companies in there where essentially, I don't think it's very extreme on capital scarcity or abundance, mainly because even though hundreds of billions in aggregate are being plowed in every year, the marginal IC has been consistently good, right? Because obviously this is a massive secular tailwind. So at some point, I'm sure it'll turn, but obviously these models are fairly slow moving. So I think it might take a little bit of time to catch up, even if it's there.
Interesting. Okay. And then another thing you guys do on the macro side really well is you're figuring out lead indicators, right? You're very focused on things that lead. So how do you go about identifying these lead indicators? How do you kind of come up with your ideas as to what, because you're a bit more out of the box, I think, than a lot of macro guys, right? In terms of what you look at. So can you give us some feel for your thought process there?
Yeah. So again, it's kind of going back to man plus machine, right? Obviously we have, you can obviously start by data mining for anything that has a lead lag in terms of turning points. I think we tend to transform all the data to really exaggerate turning points so that we're generally trying to pick up on correlations between turning points, right? That's the initial kind of way to understand if data is available. But we normally need to have the data going back at least a full business cycle. So call it on average 7 to 10 years history. So you understand it through, some big downturns and upturns. And then obviously you need it to be intuitive and explainable, because obviously there's like a gazillion correlations you can find. And this is obviously going back to the issue with potentially even LLM models and all these things, right? Because obviously ultimately it's like a correlation thing at the end of the day. So once you have the initial kind of short list, then we need to understand if it's intuitive. So, building permits, if you find building permits are leading, that's obviously pretty intuitive, right? So there's a lot of theoretically leading, lagging things. So I think leading indicators is obviously a lot more well-known these days compared to maybe 10 years ago. But yeah, things like unemployment is very lagging, right? Because no business owner is going to go out and fire their workers at the first sign of trouble, right? They're really going to, they cut their variable costs until eventually the business cycle downturn so bad, there's no choice left and they have to lay off their workers and unemployment picks up, right? Similarly, like normally, like bankruptcies and delinquencies tend to be more of a lagging indicator. So it's normally things already so bad that by the time these things are really surging in the headlines, those are quite lagging. So what are the examples of leads? I mean, typically high yield credit spreads historically have been a good lead indicator because obviously it's a sign of financing conditions. The ratio of new orders to inventories, these are very classic kind of lead indicators.
Is there any that you've got that you wouldn't think of that as that obvious, but you've actually found them to be really, really useful?
Yeah. So one is I think so in macro, most of the data is actually pretty highly correlated, right? So there's basically like a collinearity problem. So if you try and take a bunch of macro data and reduce the dimensions, typically like the first 3 dimensions explain like 70% of the moves, right? So like, if you have like 20, 30 inputs, you're just giving yourself a false sense of security and overfitting. So in that sense, it's not so much about like there's some magic secret lead indicator. I think it's just understanding a lot of them are going to be correlated because they're picking up on similar themes. And then it's just thinking about what is more sensitive and more leading. So, an obvious example would be South Korea is very exposed to global trade, right? It's a big exporter. It was sensitive to China, but through semis, it's sensitive to other things, right? So South Korea and Taiwan inventories tend to be more of a lead, even for, like other countries like in Europe, right? Even though you wouldn't think so. Similarly, Sweden is a smaller, more open economy, right? they obviously got housing book rate sensitive, so they tend to be more leading. So there's a bunch of these kind of things that will spit out that on first thought you might be like South Korea is not directly linked to Europe, right? But you know, if Europe is Germany, Germany's depending on China, South Korea leads China, then you get some of these relationships that spit out. So yeah, those are probably examples that again are pretty intuitive. And you tend to observe the kind of sequencing of the turning points.
Okay, yeah, great. So you keep mentioning man versus machine, right? So the human discretionary component, is that something that you leave your clients to sort out for themselves, and you give them the machine and the tools and the models, and then they then go and use their own discretion to kind of navigate markets and use those tools the best way they see fit? Or do you actually add a layer of that humanness on top for yourselves?
Well, I think the client can decide. If the client just wants the model, they can obviously just get the model. Obviously, when we put out research, that has our overlay
right
implicitly. And ultimately, when we're investing using our models and tools, there's ultimately obviously a layer of discretion right at the end, right? So like even this year, a classic example was if you think back to the post SVB, there was a bank run on First Republic, right? So First Republic has historically like scored super well on quant models in terms of business quality. Like people love that business, you know, they had very good ROE. It was known for customer service, et cetera, right? So during that initial start of the bank run, most of the models would be is pushing this in terms of, you know, we cover like 14,000 stocks, right? It's basically going to like number one, right? But that's where you need to understand like, you know, the dimensions of a bank run and what's actually going on suggests you probably should ignore it. Now, obviously, in that case, it worked out, but sometimes, you know, it might turn. But those examples where you're like, you know, there's clearly something exogenous going on that the model was not designed to kind of capture.
Yeah, there's a fat tail that the model isn't aware of, basically, right? So that's where your human discretion says that fat tail is something I don't want to be involved in or take the other side of, basically. So even if I miss the upside because the model nailed it, I'd rather miss the upside so I don't have to take the negative tail event risk that this thing can really go pear-shaped, right?
Yeah, and obviously you also want some intuition that the model is behaving as intended, right? Because in a way, when we talk about man plus machine, you know, when we talk about market history, it's essentially you're trying to understand how the world actually works from a first principles point of view. And then your model needs to actually behave according to that, right? So when you have times when the model behaves against it, then you have some discretion to kind of turn it off, right? Just like, obviously, you know, you look a lot at option market and stuff, you know, I remember asking you a lot of very practical questions, right? Like when you actually implement, like who is actually going out there and putting on like call flies, put flies? Not many people, right? In practice, it's like a theoretical thing people might think is really cute on paper. In practice, not many people's trying to do like a bunch of these fancy five-legged trades, right? And that's like example, I would say, in the real world, how does it work versus the theory? And I think that's a lot of what we're trying to spend time on understanding, basically.
Yeah, I mean, I've always been a big fan of like, yeah, do the number crunching, try and be systematic in your process, but then make sure you understand the intuition behind everything, right? Like try and understand what's going on under the hood. And when the model does break away from what you think is happening in the world, you can try to rationalize that and question that. Because like I say, every model is going to break at some point, right? Every model has to have some assumptions embedded in it. So by definition, they're going to fail at some point. It's just you need to be aware enough to not rely on them so blindly that you can't catch it when that happens, right?
Yeah.
Cool. And then, so what's your sort of future plans though at Variant Perception then? Like you guys obviously do put out amazing macro research. Are you changing? Are you evolving? Like what are your plans?
Yeah, well, I think despite the quite difficult, I guess, broader business environment, I think we're doing pretty well at the moment. I think our unique edge is probably more on, you know, doing the R&D, building models and making the tools. So I think that's probably the primary direction we're going in. But obviously, these things naturally translate to obviously data products, right? The models are there. It translates to a kind of different paths. But yeah, I think, you know, it's important to understand probably what your ultimate kind of edge and value is, right? And I think for us, it's about, being able to do this man plus machine effectively be like a overlay, but that can cover everything. Maybe we're just 80% of single stocks, 80% of vol trading, 80% of macro, 80% whatever else. But I think we've accumulated a bunch of these models over time, so it's quite a nice kind of check that's kind of instantly available for clients via our portal, right? So that's kind of in my mind where we fit right now. But yeah, we'll see what happens in the future.
Well, mate, well, it's been great having you. And one thing I want to ask you before you go, which I think it will benefit the listeners, because you're so well read. Like you said, that is part of your actual process at VP to like figure out where you're going to go. You read so much. You're a student of history. So what would you say are the top 3 books for someone who's trying to understand the world, markets? Like, what are the top 3 books that you would recommend for people to read? Because I think out of all the people I've interviewed, you're definitely one of the people that I think that's a good question to ask too. Yeah. Put you on the spot.
Yeah, obviously I can't really speak for other people in terms of the stage. I can just tell you 3 books I remember that had a foundational impact on me that caused me to change how I did things. So the first one I always say is The Volatility Machine by Michael Pettis. Right. I think it's pretty old now. I remember asking him before if he's going to do like a reprint, but I think some of the case study examples are really are kind of like decades ago, I think, at this point. But yeah, that was like a foundational thing for me, because like it showed a lot of practical, like real world experience of investing, inverted balance sheets, and all these things. So I think that was really foundational. Mm-hmm. The other one is the expected returns. I think there's a new version that's come out, right? Like I think new version is called like expected returns in like a low rate world or something. I can't remember the name, but yeah, that's that's a bit more academic, but it gives you a good sense of the different sources of premium, liquidity premium, vol premium, so forth. So in terms of understanding intuitively first principles, what are the things you should be doing that you should actually have positive expected payoffs over time. Mm-hmm. I think that was really good, but those books are probably not the most accessible. I would say you probably need a little bit of background. In terms of things that are a bit more accessible, Joel Greenblatt's books are really good, like How to Be a Stock Market Genius. I think it's like called The Little Magic Book, right? I think that was pretty good. Obviously, Capital Returns I mentioned by a Chancellor. I think those books are really, really. I remember reading and thinking, okay, I'm gonna go try this, and then that takes you down kind of the rabbit hole kind of thing. So yeah, those are probably the main ones that come to mind.
All right, well, good. That gives some people something to get the teeth.
Well, what's your one, by the way? Have you given out your book list?
I haven't, because I've historically been a terrible reader over the years. So I'm good at sort of learning by doing. And, I remember when I first started options, I tried to read whole, gave up after about a chapter, started reading Sheldon Natenberg, which everyone calls the Bible, thought it was relatively good, but probably still didn't get through it. So I'm one of those people who does generally learn by doing. And in the new age of podcasts and YouTube videos and stuff, I didn't cultivate, I'm trying to change that now. I didn't cultivate a very good habit of reading. So now I've bought like 10 books in the last month, and I'm trying to change. But historically, that's not something I've done well. Like in terms of Market Wizards, I really liked that. That resonated a lot. And it's because of the practical experience of all these market legends that you can learn from. But yeah, I wouldn't say anything was that life-changing for me in terms of that really sticks out. Yeah.
I wish I know at the time. I remember on my internship, you made everyone read Natenberg.
Yeah. No, I hadn't even read it cover to cover myself. That's quite funny. But you know what? The point is, you want to point people in the right directions, and then they find their own way, right? So just like I found my way, you found your way, but you kind of need to be steered in that direction, right? So, and that's what we're doing here, Options Insights, still, right? Like, I don't claim to know everything about everything. I'm still learning daily from the market. And if you don't have the kind of perspective that the market is going to keep teaching you and it is going to keep changing, and you don't know it all, then you're going to learn a very harsh lesson one day when the market reminds you of that. So that's kind of what I try to teach. But anyway, mate, it's been a pleasure to have you on. It was good to finally get this done. I know we've been intending to do it for a while. I hope the viewers enjoyed it and got a lot from it. And all the best over there at VP. And I'm going to keep reading your research very keenly, especially the short-term trading signals that I can do option trades around. But yeah, thanks a lot, man.
Yeah, no, thanks to you. Same to you. Yeah, thank you.
Cheers.